Good morning, and thank you so much for joining us. I'm Tim Stenovec. I'm an anchor for Bloomberg Quicktake and Bloomberg Business Week Radio, and I'm very pleased to be joined by Gina Martin Adams. She's Chief Equity Strategist for Bloomberg Intelligence. It is great to have you with us, and this is a perfect day, Gina, because we've had 5 straight days where the S&P 500 has changed directions from the previous day. Today is shaping up to be a 6. They've also been big moves. I'm wondering what exactly is going on with volatility, because we've seen 5 days in a row of more than 1% move. So what's up with this?
Well, I think there's a lot going on, Tim. First, thank you for having me. Lovely to be here with you today. In terms of volatility, one thing to just consider is seasonality. October is typically a very volatile month. We all think, of course, of major crashes in the past, which shall not be named. But nonetheless, what you typically see is a market that is very weak in September, followed by an average market in October, but a characteristically very volatile month in October. I think also it's really a follow-on of what we've experienced over the last several weeks. Really starting at the beginning of September, investors just had this plethora of issues to contend with inflation pressures lasting a little longer than expected, certainly Fed policy shift on the horizon, a lot of concern over what's happening down in Washington with respect to government shutdown and now debt ceiling. You know, there's just a lot to consider, and these moving parts are creating some degree of volatility, which we frankly hadn't seen in so long. It feels a lot worse than maybe it really is.
So buckle up for Q4?
I do think Q4 is going to be very interesting because all these issues aren't necessarily going to go away. And certainly one of the biggest issues that we've been watching really carefully is what's happening with earnings forecasts, what's happening with earnings results, or likely to happen with earnings results amid all of this risk. And certainly it's taken a back seat to a lot of the more exciting headlines with respect to policy changes coming from either the fiscal or the monetary body. But frankly, this idea that inflation is sticking around for a little longer than many analysts had forecast is likely to be the big takeaway from the third quarter earnings season coming up. And we're starting to see that reflected in expectations.
Okay, so talk a little bit about that, because in a recent note, you write that inflation is sneakingly chipping away at an optimistic outlook for the S&P 500. Why do you think that investors should pay more attention to inflation, especially when policymakers are saying it's not going to be around forever? This is something we think is going to be transitory.
Yeah, it's a great question. I think we need to pay attention to it for a number of reasons, but most profoundly in the short run, we need to pay attention to it because even though policymakers are telling us it's not going to be around forever, it is still sticking around for a little longer than anyone had anticipated, at least in the short run. And we're seeing that reflected in analyst expectations. So far, roughly half of S&P 500 company estimates for operating margins, which is the manifestation of inflation pressures in the earnings stream, those estimates have dropped for third quarter and for fourth quarter season. We've not yet seen a downdraft in the forward 12-month outlook, which I think we want to watch for, but it is starting to chip away, and that's having pretty meaningful impact on price, where the companies with the greatest downward estimate revision to margin expectations are experiencing price pressures.
Could they then pass on those price increases, that margin pressure, to consumers and then not see that margin pressure? Do they have that pricing power?
I think for the most part, no, and that's what we're seeing reflected in the estimates. Is what we're seeing is top-line estimates are not moving. Top-line estimates are actually still rising net for most of these companies. They're still experiencing very, very strong revenue growth, but they're unable to pass along the price increases in total because their bottom line estimates are moving lower. So we know for sure that what's happening is somewhere in between revenue and EPS, we're starting to experience some pressure. It's not by any stretch of the imagination pervasive. It's not every company in the S&P 500 experiencing distress, but it is about half of them, at least in terms of analyst forecasts, experiencing a little bit more distress than many people had anticipated for at least the next quarter or two.
So inflation and monetary policy, associated monetary policy, it gets a lot of attention right now, but you recently argued in a Bloomberg Intelligence note that fiscal policy deserves a lot of attention too. How should investors be thinking about margin pressure and equity returns if Democrats do succeed in raising the corporate tax rate?
Yeah, I think this is one of the most profound considerations that people are sort of just pushing to the sidelines. We saw this happen in the reverse in 2017, 2018. Markets certainly started to price for corporate tax reform at that time, but analyst estimates really didn't move. Analyst estimates, in fact, didn't move until December of 2018, after the tax policy was passed. In that period of time, we saw net income margins on the S&P 500 jump 200 basis points because of that tax decline. It's a huge margin boost that we experienced. We have not seen analyst estimates change at all for net income margins. Only the operating margin component of that is changing. We're not seeing any sort of imputed expectation for higher tax rates going forward. The result is, if we do get to corporate tax reform, in my mind, we have to have a repricing of the earnings stream. Now, what will that tax reform look like? I think there's a lot of question marks, and this is one of the reasons why we haven't priced in a lot. We don't know if we're going to get a spending package, a fiscal spending package that needs to be funded by tax reform. We don't know what rates those taxes are going to come in at, but nonetheless, we will have to price a tax increase if we see corporate tax reform, and that's going to get reflected in a downdraft in net income margins, which we haven't seen on the S&P 500 in quite some time.
Would any of that be offset with economic growth that comes as a result of these packages that are trying to make their way through Congress?
I think that's a very reasonable assumption that we could get some offset, but when we run through the scenarios, we take, say, 50% of a potential infrastructure package actually impacting S&P 500 revenues over the course of 3 years, and we impute an assumption for the corporate tax rate coming in somewhere around 25% effectively, and the net result is still a drag on S&P 500 earnings. That tax rate makes a very meaningful impact. Now, you have to make a lot of assumptions, obviously, as to the efficacy of fiscal spending and a multiplier effect on the economy, but nonetheless, I think 50% bump, or 50%, if we assume 50% of that goes directly to S&P 500, that's a pretty optimistic assumption over even just 3 years. So you could see a much bigger drag than even our scenario analysis suggests.
Okay, well, back to monetary policy from fiscal policy and talking a little bit about the more hawkish tone that we've had from central banks around the world. As the Fed begins to think about tapering, give us some insight into the relationship between the Fed's balance sheet and what historically we've seen when it comes to returns in the S&P 500.
Yeah, really intriguing, almost one-to-one relationship between what happens with the Fed balance sheet and what happens with the S&P 500. I'm oversimplifying, of course, but nonetheless, we have seen when the Fed balance sheet is accelerating, the S&P 500 returns tend to accelerate. And the opposite happens when the balance sheet is no longer accelerating, or even when the balance sheet has flatlined, the S&P 500 has entered a period of distress. This is a very tried and true relationship that developed over the course of the last 10 years or so. So there's natural jitters that have evolved as a result of this potential taper. I think there are still a lot of questions as to what the taper looks like and when interest rates are likely to rise. And these questions have really started to bubble up starting this summer. And we're starting to see that reflected in sector movements and factor movements in the S&P 500 already. But historically, what tends to happen, or at least what happened over the last 10 years, is a taper is not necessarily meaningful. It just means that the balance sheet is likely to rise at a slower pace. The S&P, therefore, you could make the broad assumption or the wide sweeping assumption that it would then rise at a slower pace as well. It's really those periods of time when they stop purchasing assets or even start to shrink the balance sheet that have been difficult for stocks. The other aspect of it is what happens with interest rates. And when interest rates go higher, what's the meaning behind that? I think this is a really challenging situation at large because the combination of monetary and fiscal policy together are now roughly 60% of GDP. And then we sort of take a back seat on this and think about just where we've been over the course of 2020. We've had such remarkable fiscal and monetary policy infusions. Backpedaling from that environment is inevitably going to be challenging.
Hey, Gina, I want to end with just thinking about holistically where we are when it comes to the U.S. economy, because you use the economic regime model at Bloomberg Intelligence. Explain what that is and really where that leaves us as we get into Q4 and head into 2022. How's the U.S. economy doing?
So we've taken a view, we try to take a view on where we are in the economy to derive our expectations for potential market returns. The economic regime model is one of those ways in which we do that. We've developed a logistic regression that really analyzes just a small subset of economic indicators that are very meaningful for deriving expectations for the economy. And it rates the economy on a scale of 0 to 1. Typically, the economy is somewhere very, very close to 1, running very, very fast, moving forward. It's been extremely hot from spring of 2020 to today. It's been running very close to 1. As of August, it likely peaked, and we've started to see the economy edge off of that peak rate. Does it mean necessarily devastation? We're nowhere going to 0, which is effectively recession. No, but it does mean a slowdown in economic growth is likely, and the natural result of that will likely be a slowdown in your expected rate of return for the S&P.